All right. Welcome everyone to today's Emerging Markets Strategy Update webinar, which is going to focus on India. I'm Eric Anderson. I'm the head of Emerging Market Investments at Milltrust International, which is a London and Singapore-based asset manager with a core focus on delivering global emerging market solutions to investors. For today, after a brief introduction from me, we're going to hear from the Indian investment manager, Marcellus Investment Managers. Marcellus was founded in 2018. The founders have worked together for more than 15 years now, which has helped shape a very successful investment philosophy and strategy for the Indian markets. The team seek to invest in heavily moated companies that can generate healthy earnings growth for long periods of time. They've developed a proprietary, well-defined framework to identify these companies. Today, we're going to hear from the members of the investment team, including the CIO Saurabh and the PM Rakshit. Everyone on the team has been a top-ranked analyst in India for many years. This is also the team that came out of Ambit Capital, which had one of the most successful and highly rated research teams in India. The current Indian strategy that Marcellus runs on the Milltrust platform has already won awards, including one of India's top performing equity products in 2018 and 2019. After a short presentation from Marcellus, we'll have opportunity to open up to questions from the listeners. To ask a question, simply type it in the Q&A section in your Zoom panel. You can ask them at any point during the presentation, and we'll get to it at the end. And we'll try to keep this to 30 minutes. So if we don't get to answer all your questions, we'll follow up directly afterwards. And as normal for these webinars, before handing off to Marcellus, I just want to quickly explain how Milltrust fits in. Now, our approach at Milltrust is to identify leading locally based investment managers in each of the key countries and regions across the emerging markets who are specialists in putting together high conviction portfolios of high quality companies. Each specialist team, which you can see here on the map, manages their regional portfolio within a sub-fund on the emerging markets platform. These sub-funds form the basis of our global EM strategy. Investors can either invest directly into the sub-funds, such as the Milltrust Marcellus India Fund, and build their own exposure to these countries and regions, or invest through the Milltrust Global Emerging Market Fund, which allocates across the sub-funds on the platform. So I think that's enough for me. I'm going to hand it over to Saurabh and the Marcellus team.
Thank you very much. Thanks, Eric. Thank you for hosting us. So folks, I'll begin by presenting to you our investment committee. There's three of us in the committee. And as Eric mentioned, Rakshit, Pramod, and I've been working together now for 18 years. So before we moved to India, in 2003 in London, I set up a company called Clear Capital. For several years running, first myself and then Rakshit, we were amongst the top small cap analysts in the UK. We sold that company in the early months of 2008. We migrated to India. We then built Ambit Capital. We took Ambit Capital to a market leading position in India. And for several years running, I was India's top strategist, equity strategist across all sectors. 2018 is when the three of us set up Marcellus. Pramod and Rakshit have been as much a part of the success story, so I'll request them to introduce themselves. Pramod?
Thanks, Saurabh. So yeah, I mean, I started off as an electronics engineer and later on worked in the semiconductor industry for a bit before doing my MBA. Post my MBA, I went back to the tech industry in more of a business development role, and that's when I joined Saurabh in Clear Capital as a technology analyst. Before moving into equity sales and later on running the institutional equities brokerage business for Ambit Capital. And finally, in 2018, joined hand with Saurabh and Rakshit to found Marcellus. Rakshit?
Thanks, Pramod. Hi, I'm Rakshit Ranjan. I manage Marcellus's Consistent Compounders Fund, and I'm also part of Marcellus's investment committee, as Saurabh mentioned. I'm a BTech Bachelor of Technology from IIT Delhi and a CFA charter holder. Total experience of 17 years in equity investing. And prior to joining Marcellus, I was at Ambit Capital for about 9 years, including the last 2 years when I was the fund manager for Ambit's flagship PMS. Prior to Ambit, I was a sell-side research analyst in the UK covering UK-listed insurance stocks. Thanks. Saurabh, back to you.
So I think it'll help, Pramod, if you could just give a sense to the viewers of to the audience of what we do and how long we've done it for, and then we'll get into the strategy.
Sure. Yes. So we manage close to about $1.6 billion across all our strategies. The investment philosophy is common to all our strategies, which Saurabh will quickly get into. But the same philosophy is applied across different opportunity sets to form these strategies. The opportunity sets are by and large driven off market capitalization. The consistent compounders, which we'll be talking about today, is largely a largish mid-cap focused strategy. The little champs, which is more of a small cap strategy, and our latest on the market cap spectrum is Rising Giants, which is a mid-cap strategy. We have one other strategy based on a sector-specific strategy, which is a financials-focused strategy called Kings of Capital. We'll just briefly allude to it, given that India's financial services are in particularly a unique phase of growth over the next few decades. Most of these strategies are in separately managed accounts. The consistent compounders, of course, is also available on the Milltrust platform for foreign investors to invest in. Most strategies which have been around for more than 2 years have been performing exceptionally well, have been consistently in the top quintile. The oldest strategy, which is the consistent compounders, which is now, in fact, as of today, is exactly 3 years old, has outperformed its benchmark by 10 percentage points per annum, almost consistently. It's compounded at 27% in rupee terms and 23.5% in dollar terms over these years. Over to you, Saurabh.
Thanks. Thank you, Paul. So folks, the central insight which underpins everything that we do, and something that we hit upon 7 years ago, is that India is getting networked and getting networked very fast. More highways, more broadband, more bank accounts. Just to put it in context, 50 times more broadband connectivity now than, say, 13 years ago when I migrated to this country. In addition to that, you have the goods and services tax 4 years ago, and you have the unified payment interface, which allows for cashless transactions across the country, even inside the remotest villages. This networking of a country of 1.5 billion people is playing out in favor of efficient, well-managed franchises. These franchises are using technology and using their competitive advantages to scoop up 80% of their industry's profits, right? This is the sort of main theme in the country. At the national level, this is leading to very powerful polarization of profits. The chart on the top right? Today, India's top 20 corporates account for 90% of the nation's profits, right? Incredible polarization, and it's happened in the space of 10, 15 years. For investors like us, this is a great opportunity to benefit from identifying both emerged and emerging sector champions who have strong barriers to entry. This strategy, and we'll show you this in a minute, this strategy works across sectors. It allows us to invest in franchises which consistently compound their free cash flows and hence our returns at 25%, right? So that's the sort of core insight which allowed us to build this strategy. The mechanics of it, I'll get into in a minute. So the investment process is simple. Pramod, if you can move forward. Yeah, the investment process is simple. Step one is the team of now 15 chartered accountants applying our proprietary forensic accounting framework to weed out naughty companies, right? Around half the Indian market drops away here on naughty accounting. I will go into the forensics in a bit. Second step, using a capital allocation framework to look at companies where return on capital is consistently above cost of capital over the last 10, 15 years, right? Simple framework. This eliminates another 50% of the universe. We actually left with only 40 odd companies. And that's when our analysts get to work doing bottom-up research using the proprietary longevity framework, which Rakshit will give you more color on, right? This process, clean accounting, good capital allocation, powerful barriers to entry. This process can take up to a year because often we find that other than the management team, no more than half a dozen people in the entire country will actually understand how that franchise works and how that franchise generates a very high return on capital. And until we have clarity on this subject, and especially until we have clarity on the barriers to entry, we don't invest, right? We'll do a case study. If there's time today, we'll get into a case study. So let me now delve into the investment process in a bit more detail. Right, so we'll start with forensic accounting. And it's a proprietary framework. We use 12 forensic accounting ratios, which we developed in our first couple of years of meeting corrupt companies in India when we moved to India in 2008. Every year in December, our 14 forensic accountants apply these 12 forensic ratios to the 500 largest companies in the country. These ratios are basically being used to rank companies vis-a-vis their peers and being used to assess the quality of their accounting. So for example, is the said company overpaying its auditors relative to its revenues and relative to its own past? Is the said company converting profits into operating cash flow at the expected rate, right? Given what we know about the working capital cycle in that sector, and so on and so forth, right? The more ratios a company suffers on, the lower the accounting quality. And as the chart on the bottom right shows, accounting quality itself drives 7 percentage points of annual alpha for us, right? This process, as I said, roughly eliminates 40 to 50% of the market and then takes us through to the capital allocation piece. So I'll request Rakshit to take over at this point, take you through capital allocation and our longevity framework. Rakshit, over to you.
Sure, thanks, Saurabh. So on the list of companies which clear our accounting quality checks, we put the next filter of assessing their historical capital allocation track record, where we look for companies that have already delivered more than 10 to 15 years of consistency in the past on returns on capital employed greater than 15% each year, and revenue growth greater than 10% each year. 15% is the cost of capital roughly in the country, 10% is the nominal GDP growth at least. And in effect, we're seeking companies which have sustained high pricing power consistently for longer than a decade and have then reinvested the free cash flows out of the high pricing power back into areas that deliver growth for the business without compromising on the overall business's pricing power. The key reason why we seek consistency of historical fundamentals is that we want to avoid speculation around fundamentals being volatile, and we want to avoid picking up companies which possess unsustainable pricing power, which do not have prudent capital reinvestment approach. So that's the historical filter. What comes out of this, let's go to the next slide, slide 10. Yeah, so there are no more than a couple of dozen companies that clear our first two filters, accounting filter that Saurabh explained and the historical capital allocation track record filter that I explained just now. No more than a couple of dozen companies cross these. And on this set, our team of 14 odd analysts, we apply our longevity framework, which you can see on this slide. This longevity framework assesses the prevalence of high pricing power today and its sustainability into the long-term future. The longevity framework is in a way used for diligencing and position sizing in the portfolio across the stocks. So the framework broadly has two parts to it. The left half of the chart that you can see, the left half of this slide, is the here and now. This is simple, straightforward, conventional stuff, which gives us comfort on the existence of significant barriers to entry or pricing power of a degree that ensures that neither profitability nor market share of our portfolio companies comes at risk in the face of intense competition, right? Now, once that has been ascertained, it is the right-hand half of this chart, right half of this slide, which is hard work. Our job, as we see it, is to estimate for how long can the high pricing power sustain, along with growth in the business. At times, whether it will sustain for 5 years, 15 years, or as long as 25 years, right? The longer the sustenance of pricing power, the more valuable the franchise. And the longevity of this compounding of free cash flows is effectively driven by two qualitative factors that we spend a lot of time quantifying. One, which you can see as the lethargy score vertical, and second, the succession planning. The lethargy is the energy, the enterprise, the imagination shown by the management team of our portfolio companies in redeploying surplus capital into newer avenues. We want tangible evidence of our portfolio companies investing capital towards, firstly, incremental strengthening of their core business. Secondly, addition of new revenue growth drivers, which also have higher pricing power. And finally, radical disruption at least once every couple of decades of their own industry in order to make their business difficult to replicate or disrupt easily by competitors, even in the longer run. The last piece, the succession planning vertical, which you see, is the continuous grooming of the next generation C-suite in these companies, so that lateral hiring is minimized and a very vibrant, energetic corporate culture with hard to replicate systems and processes sustains and evolves. So that's the longevity framework. let's look at the outcome of this. So let's go to slide 11. So CCP, our consistent compounders portfolio, typically beats the benchmark by around 10 percentage points, as Pramod previously mentioned. And that can be seen over the last 2 years or 3-year time period. However, when you look at the last 12 months, we've marginally underperformed the benchmark index. And that's how our portfolios are actually designed to perform. This sort of an underperformance is sort of something we've described in our best-selling book, Copy Can Investing, where our aim is to strongly outperform in a crisis. For instance, in Jan, Feb, March 2020, where we fell half as much as the broader market, the outperformance was massive. It was more than 30-odd%. And the outperformance compresses in a euphoric external environment, which is what has prevailed in the last 12 months. On a related note, we run concentrated portfolios of 15-odd stocks with top 4 positions in the portfolio accounting for around 40% of the portfolio allocation. Saurabh, let's go to slide 12. Yeah. Now, just breaking the outperformance down into its ingredients. So the consistent compounders portfolio's entire outperformance arises from EPS growth, earnings growth, which itself tends to be 10 to 15% better than that of the benchmark. So you can see that our superiority in the EPS growth generation is demonstrated in the table on the left, which is almost identical to our superiority in alpha generation, which is demonstrated in the table on the right. And this also implies that our alpha is not driven by PE multiple or valuation re-ratings of our portfolio companies. So that's about the components. So let's go to slide 13. Yeah, and now the superior EPS growth in turn is driven by high barriers to entry, which fuel high returns on capital employed. Our portfolio companies, as you can see in the last column, they reinvest the outcome of high return on capital back into the business at a higher proportion, and there are, as a result, several high return on capital businesses. Unlike, say, so let's compare our portfolio companies with, say, a Colgate or a Hindustan Unilever or a Castrol, right? Colgate, Hindustan Unilever, or a Castrol are high return on capital businesses, but they do not have high rates of reinvestment of capital. We avoid such franchises, right? We want both high return on capital as well as high rate of reinvestment sustained over long periods. Now, when it comes to free cash flow generation as a result, so let's go to the next slide. Our portfolio companies consistently use technology investments, and they improve their systems and processes in order to reduce working capital cycles and expand inventory turnover by sweating their assets harder. They do this not as a one-off exercise. They do this consistently year after year. As a result, what you can see in the table on the left, the free cash flow of our portfolio companies compounds at growth rates which are 8 to 10 percentage points higher than their rate of earnings growth. So the rate of earnings growth tends to be around 20-odd%. Free cash flow compounding is in the high 20s. Over the last 20 years, these portfolio companies have compounded at sort of 25-30% their free cash flows, which you can see in the last column of the left-hand side table. And then even if you break that 20-year time period down into 10-year or 5-year subsets, historically, the rate of compounding has been very consistent without compromising on the health of this compounding CAGR, regardless of how difficult or how benign the external economic environment is. This piece then translates into an equally healthy and consistent share price performance, which you can see in the table on the right. So I'll pause here. Sort of back to you on how our team builds its edge in constructing high quality portfolios.
Thanks, Rakshit. Thank you. So, folks, obviously, all of this, it can't just be the sort of the intellect of one or two people to consistently generate high quality results. We have to build the firm in a certain rate. Right? So, what we have done is we have designed Marcellus to benefit from the profit polarization dynamic that's playing out in India. I mean by that the roll up of the country into the hands of 20 super efficient companies. In fact, one of the very reasons for building out an Indian high net worth franchise is that itself becomes a great source of primary data for us. Basically, we manage money for the people who manage India. That's the sort of bottom layer of that pyramid in that chart you see in front of you. Over 1,000 Indian business owners are our first layer of clients. In addition to that, we've built over the last 13 years primary data contacts, around 2,000 people, civil servants, scientists, management consultants, regulatory experts, people who can give us a unique perspective, trusted, unique perspectives on what's happening in the nation. Those are the two bottom layers of the pyramid, and these two layers of the pyramid play a critical role in helping us crystallize our thinking on barriers to entry. Unless you or I am able to understand companies like Asian Paints or a Titan or a Bajaj Finance in a completely different way from the typical Indian fund manager analyst, you and I won't be able to generate alpha consistently. In order to do that, you need superior sources of insight. That's the fundamental foundation on which this business has been created. Our research team then specializes in forensic accounting, as we described. And finally, the investment committee, which is the three of us on this call, works in a way where all buy and sell decisions are taken on a majority basis rather than on a consensus basis. Dissent is encouraged in the IC and in the firm. The research team meets twice a week, and explicit credit is given to analysts who successfully mount a challenge on any of our fund managers' holdings. So I think in the interest of time, we'll stop there. And Eric, back to you.
Thank you, Saurabh, Pramod, and Rashid. That's very interesting. Yeah, we do have questions coming in. It's sort of the inevitable India questions. We are, I would define as an underlying bull market in India. There's still plenty of catch up as well after the second wave of COVID happening. But this has also led to very expensive valuations, right? And if you look at even with an EM context, despite the strong earnings. So how do you talk to investors? How do you convince investors? How do you justify these valuations? How do you say, yep, it's still fine by India now, despite the sort of lofty evaluations? Perhaps you can speak about that.
Rakshit, do you want to have a go?
Sure. So can we move to a slide right towards the end of the pack? I think slide number 30 or something. Yeah, that's it. So folks, the biggest source of undervaluation in any great company's share price is around the longevity of its fundamental strengths, rather than just the prevalence of these strengths in the here and now, right? So it's the longevity rather than just the existence here and now, which drives undervaluation. Just to quantify and hence answer the question Eric posed. Just to quantify the degree of such undervaluation, let's use a simple DCF approach, which is summarized in this exhibit. So if there's a business, let's say indicated by scenario 1 here, if there's a business which compounds free cash flows at around 25% CAGR over the next 5 years, and then undergoes a fade because of uncertainty, weakness, or unexpected disruptions, etc. happening. If it undergoes a fade after 5 years of 25% compounding, its fair value PE multiple today would not be anything more than, say, 25 times, right? Which you can see in the last column, sort of as encircled it. Now, on the contrary, though, if the assessment of sustainability prospects of greatness suggests to you that the business will be able to sustain 25% CAGR in its free cash flows, not just for the next 5 years, but probably for 15, 20, 25 years. And then maybe it might undergo fade. In that case, the fair value PE multiple of such a business will be as high as 250 times maybe, right? Now, this becomes, as a result, it becomes a very important exercise to deeply understand the factors that drive longevity of a business. So just like we explained previously, we've got a longevity framework. Various softer and harder aspects of the business are assessed to ensure that the business doesn't face uncertainty around external environment, around competition, around internal succession challenges, capital redeployment challenges, so on and so forth, right? If there are enough number of reasons available to us to believe that it's not a 5-year longevity, it's more like a 15, 20, 25-year longevity, then such businesses, they are cheap compared to their intrinsic value, regardless of the current PE multiple, which could be 40 times or 50 times or 60 times, right? So just because in the last, say, 2, 4, 6 years, a 30, 40 times PE multiple has become 50, 60 times in our portfolio, doesn't mean the intrinsic value is pretty much there now. They are still deeply discounted, and hence we continue to invest in them, because the biggest driver of their share prices going forward will not be the PE multiple, it will be the rate of growth of their fundamentals sustaining into the very long-term future. And our portfolio companies are composed of only such longevity-oriented businesses depicted in scenario 3 of this slide.
So Eric, just to link this to that network of experts that we have built, right? So let's take an example. Let's take Asian Paints. A typical fund manager based in London, New York, Singapore, in some global money center, they will say, well, let's look at Sherwin-Williams, the world's largest paint company. Perhaps let's look at AkzoNobel, the second largest paints company, and they will use that to reference Asian Paints' PE multiples, right? In doing so, they will not actually be able to get their heads around Asian Paints, because Asian Paints' operational model is completely different from Sherwin-Williams or AkzoNobel's. Asian Paints actually is less a paint company. It's more a big data and tech logistics company. To understand Asian Paints as a big data and tech logistics company took us 2 years of research. And even though we have written books which have sold by the tens of thousands, we still don't meet too many Indian fund managers who are actually able to understand that Asian Paints is actually a technology company which derives its 40-45% ROC and its 25% free cash flow growth decade after decade on the back of technology, rather than anything to do with the paint industry. So that's where the local knowledge, the local network of contacts interplays with the valuation model to give us a superior sense, a superior insight into Asian Paints' warranted PE, which we reckon is around 250 times, as opposed to the conventional perspective that, hey, this should be benchmarked to an AkzoNobel or a Sherwin-Williams, which are actually much lower ROC generating companies. Back to you, Eric.
Yeah, no, thanks. That's very insightful. Here's another one from the audience is, how do you assess new economy companies given your framework?
So obviously you can see from what we are talking about, right? The scope in India for formalizing what is currently informal, basically in the black economy, basically fragmented, formalizing the informal and then consolidating it. The scope is immense, right? So we're investing and making a lot of money from companies like Asian Paints, Pidilite, Titan, who have taken what was hitherto informal, formalized it and then consolidated it. And we are making 25% per annum. And obviously there'll be many such industries in India that will get formalized and then consolidated. There are some shining examples of that coming through in the new economy. InfoEdge, which is a listed entity, we are not invested in it in this portfolio, but InfoEdge is a great example of a company which took the employment classified space, formalized it, consolidated it, and is the unchallenged leader, right? Neither LinkedIn nor Monster nor Randstad have been able to challenge InfoEdge's dominance. InfoEdge has built a cash machine out of formalizing the informal. Obviously, what we are seeing alongside this phenomenon is many other pretenders who neither have the operational nous nor the capital allocation discipline to build a Titan or an Asian Paints or an InfoEdge. So as is the norm in any bull market, you're getting layers of lipstick being applied to pigs, and these companies are being IPO'd without any discipline in their capital allocation or without any competitive advantage, so to speak. But that's the norm in capital markets across the world. Every 10 years, you'll get a 3-year period where there will be a free for all, and the naive and the unsuspecting will be parted from their money by companies that will have the veneer of respectability around the business model, but actually won't have any underlying competitive advantage. There's nothing new in this. I think the current IPO surge around a lot of Indian tech companies is very similar to what we saw in the late 90s and in the 2006 to 2011 period, where dodgy companies raised a lot of money and then ran away.
Okay. And then I think a final question, I want to combine a couple of them here. One is on the policy side. We've seen some structural reform, this year in India. has yet to be implemented. So a lot of it's been implemented yet, so yet to be seen how that pans out. But do you see anything from a policy standpoint on the country side that it will be a catalyst for more upside in equities? Yeah, perhaps we'll finish with that one. And any kind of short-term other catalysts that you see in the next 12 months that our investors should be aware of.
Right. So I think the biggest change, if I see my own experience of helping policymakers in both Delhi and Mumbai across the last 13 years, the biggest change I have seen, right, and as I sit in various regulatory committees, is a complete realization on the policymaker's part that if he is to win elections, he has to cater to the needs of the top 20, top 30 promoters, the top 30 companies by profit generation, right? As is well known and has been written by several people, Indian elections are extremely expensive. To fight a general election in India, a party typically needs billions of dollars, right? And the sums of money spent on large elections in India run into tens of billions of dollars. To raise those monies, you need the patronage of powerful companies. And therefore, whichever side of the political divide you are on, the left or the right, you have no choice. And I speak to politicians on both sides. They have no choice. They will pander to large companies. And therefore, it is inevitable that the country will continue consolidating. 20 to 30 companies will take over the entire country's profits. It's already happened. The only thing that's left is most investors haven't clocked onto it. They've got this romantic notion that 1,000 flowers will bloom. It didn't in America at a corresponding stage in American history. It didn't in Japan. It didn't in Korea. And it's not going to bloom in India. You will have a country where 20 very powerful companies are going to monopolize this economy's profits, and your and our wealth will grow if we align our portfolios to them.
Okay, well, that's a great point to finish on. These always feels too short, but this is meant to be a teaser, kind of an insight into the world of India and Marcellus. So thank you very much for the excellent presentation, gentlemen. And thank you everyone for joining the call. As a reminder, the India strategy run by Marcellus is on the Milltrust Emerging Markets platform. You can access directly through the Marcellus India Fund or through the Global Emerging Markets Fund. My team will also be circulating a replay next few days. In the meantime, don't hesitate to get in touch if you have any questions. With that, we'll end the call. So thanks everyone for joining the call, and we'll be in touch. Thanks again.
Thank you.
Thank you.